Good news just crashed the stock market, and if that sentence makes zero sense to you, you're not alone. But by the end of this video, it will. Because what happened on Friday, June 6th, 2026, is one of the clearest examples of how the financial system actually works, and why ordinary people always seem to lose, even when the economy looks strong. On Friday, the 6th of June 2026, the United States stock market had one of its worst days of the year. The Nasdaq, the index that tracks most of the biggest tech companies in the world, fell 4.18%. That's its worst single day since April 2025. The S&P 500 dropped 2.64%, its worst day since October. The Dow Jones fell nearly 700 points, and Bitcoin, it crashed below $60,000, its lowest level since October 2024. In total, trillions of dollars were wiped off the market in a single afternoon, and here's the part that will mess with your head. The reason this happened wasn't bad news. It wasn't a war, it wasn't a recession, it wasn't a company going bankrupt. It was a jobs report, a good one. On the morning of Friday, June 6th, the US government released its monthly jobs report, and the numbers were strong. The economy was hiring, people were working, unemployment stayed low. By any normal definition, that is good news. That is exactly what a healthy economy is supposed to look like. And yet within hours of that report dropping, the stock market went into full panic mode. Billions of dollars were pulled out of stocks. Tech companies lost hundreds of billions in market value. Bitcoin collapsed. The VIX, Wall Street's official fear gauge, surged 40% in a single day. So what is going on? Why does a strong jobs report cause the market to panic? The answer is one word: the Fed. The Federal Reserve is the most powerful financial institution in the United States. Its job is to control inflation and keep the economy stable. And the main tool it uses to do that is interest rates. When the economy is weak, the Fed cuts interest rates. Cheaper borrowing, more spending, economy grows. When the economy is too strong, when too many people are working and spending and pushing prices up, the Fed raises interest rates. More expensive borrowing, less spending, economy cools down. Right now in 2026, inflation is still a problem. The Fed has been holding rates steady, hoping things cool off on their own. But that strong jobs report on Friday sent a very clear message. The economy is not cooling off. In fact, it's heating up. And that means one thing: the Fed might have to raise interest rates. Before Friday, the odds of the Fed hiking interest rates by the end of 2026 were sitting at around 45%, roughly a coin flip. After that jobs report dropped, those odds jumped to 70%. Almost overnight, bond traders started pricing in a rate hike at the October or December Fed meeting. The 10-year Treasury yield, which directly influences mortgage rates, surged to 4.54%, its highest level in weeks. And Wall Street heard all of this and did what it always does when it smells higher interest rates coming: it sold everything. Here's why higher interest rates are so terrifying for the stock market. When interest rates are low, money is cheap. Companies borrow cheaply, expand, invest, hire. Their future profits look big. Stock prices go up. When interest rates rise, money gets expensive. Borrowing costs go up. Company profits get squeezed. And here's the key part: suddenly, US government bonds become attractive. Safe, government-backed bonds paying 4 or 5% interest start looking much better than risky stocks. So investors pull money out of stocks and put it into bonds. Prices fall, markets panic. That's exactly what happened Friday. In one afternoon, the S&P 500 snapped a 9-week winning streak. The Nasdaq had its worst day in over a year, and semiconductor stocks, the companies building AI chips, got absolutely destroyed. Nvidia fell 6.2%, AMD dropped 6.3%, Marvell Technology lost 8%, the Philadelphia Semiconductor Index fell over 10% in a single session. Now let's talk about Bitcoin, because what happened to crypto on Friday is its own story. Bitcoin fell more than 5% and broke below $60,000, a level it hasn't seen since October 2024. And it wasn't just Friday. This was the end of a brutal week for crypto. Bitcoin ETFs, the investment funds that allow regular people to buy Bitcoin through their brokerage accounts, had just ended their longest ever streak of outflows. For 13 consecutive days, more money was leaving Bitcoin ETFs than coming in. Net assets across Bitcoin ETFs fell from $107 billion in mid-May to just $80 billion. And the reason? The same fear driving the stock sell-off. Higher interest rates mean safer alternatives. When you can earn 4 or 5% guaranteed on a government bond, why take the risk on volatile crypto? Bitcoin is now down more than 50% from its all-time high, and the $60,000 level is being watched extremely closely. If it breaks below that, the next major support is around $55,000. And here's the part that affects you. Not just investors, not just traders, you. Higher interest rates don't just hurt the stock market, they hit ordinary people directly. Your mortgage rate is tied to Treasury yields, that 10-year yield that jumped to 4.54% on Friday. That directly pushes mortgage rates higher. For someone buying a home right now, a rate hike could add hundreds of dollars to their monthly payment. If you have a 401k or pension, it's invested in stocks and bonds. When markets fall 2 to 4% in a single day, your retirement savings take a hit. Not on paper, in real money. If you carry credit card debt, a rate hike makes that debt more expensive. The interest you're paying goes up. Your minimum payment goes up. The hole gets deeper. And if your company relies on borrowing to operate, higher rates mean higher costs, which means possible layoffs, hiring freezes, or slower growth. One jobs report, one afternoon of trading, and the ripple effects reach into every corner of your financial life. So what does all of this mean going forward? The odds of a Fed rate hike by October or December 2026 are now sitting at around 70%. That means there's a strong chance borrowing gets more expensive before the end of the year. Markets are going to stay volatile. Every economic data release, jobs numbers, inflation figures, consumer spending is going to be watched with extreme anxiety. Any sign the economy is running hot could trigger another sell-off. And here's the brutal irony that nobody in power will say out loud. The Fed wants the economy to cool down. And the way it cools down is by people losing jobs, spending less and borrowing less. A strong job market, people working, earning, spending, is actually a problem for the Fed's inflation fight. So when workers are doing well, the system punishes the market. And when the market suffers, ordinary people lose savings, retirement funds and access to cheap credit. You can't win unless you understand what's happening. And now you do. This is what Broke Economy is here for, not to tell you the market went up or down today, but to explain why and what it actually means for the people who aren't sitting in trading floors on Wall Street. If this video made the system make a little more sense, subscribe, because there's a lot more of this coming and you need to see it.